Regan's a local lender here in Hawaii, works with a lot of residential loans. A lot of the same questions happen again and again, and that we kind of roll through some of your top questions you're getting from a lot of your clients.
In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We just two local guys with
All
so
right,
much
hey,
to
simple
say.
passive cash
So
flow
listen
listeners,
to the
and
real
also
estate
RA
brothers
Aloha
today.
Club members. You guys can check out our local Hawaii website at raaloha.com. But today I wanted to bring on a local lender, Regan Onikama, who also went to MidPac too.
Thank
But
you for having me.
so hopefully people can listen to this in the future and at least not get blindsided by some of this stuff should it happen to them, or be wary of it as they move through the closing process. First question here is, like, can all this stuff be done online? Kind of take us through the process.
Yeah, our company is very technology forward. So we have an app that borrowers can download. They can fill out the loan application right from there, and they can upload their documents right from there as well. If they rather do it from a computer, we have an online link that will link them to the loan application. And again, everything can be done by email. It'll go to a secure email. It'll go to a secure portal. And everything pretty much can be done online. Although I do like to make the first phone call just so I know what I'm dealing with and I know what I'm asking for from the borrowers. It's also a way for us to kind of get to know each other a little bit better, because the loan process is very, very invasive. I mean, we ask for everything short of a blood sample.
Yeah, DNA sample and all kinds of stuff.
Yeah,
But
exactly.
yeah, I mean, I'll say it, like, it's gonna take, what, about like 3 to 6 hours, depending how organized you are with all your financials and your W-2s and bank account statements, to fill out these forms and get it to your lender. And when you're borrowing $500,000 to $1 million from the bank, yeah, you bet they're gonna ask for this stuff, not just handing out free money.
Yeah. I mean, we have so many guidelines that we got to adhere to. Ability to repay. We got to make sure the money is seasoned. Got to make sure the credit is credit worthy. And then on top of that, we have to make sure the property, the collateral for the loan itself, is acceptable as well. So it's a daunting process. It shouldn't take 3 to 6 hours. Normally, we can get away with 2 pay stubs, 2 years W-2s, 2 months of bank statements, and in some cases, 2 years of tax returns, depending on their employment situation. But yeah, we do have to verify everything and cross our T's and dot our I's very, very much so throughout the whole process.
So a lot of these loans that guys are gonna get, mostly
Mhm.
Fannie Mae, Freddie Mac. So
Mhm.
it's not Regan making the rules here, but
No.
so let's start out first, just for people without any money, and they can stop listening now. What is the minimum down payment that you need to buy a home?
There's programs, believe it or not, that allow for no down payment. uh, VA loans, for example, they are zero down programs depending on how high of a house you're buying. And actually, next year, it's January 1st, 2020, it's changing where you can, it's the first time you're using your VA eligibility, you can go zero down up to whatever purchase price you're doing, as long as you qualify for that amount. Other zero down programs are like the USDA program, but those are income restricted, and it's also geographically restricted. So you have to be in an eligible USDA area. But I would say, average down payment, could be as little as 3%, as much as 25%. If you're looking at investment properties, you're looking at probably 20%, 25% will get you the best rate in terms, though. So there's options out there for you, and there's options for down payment assistance if it's available through state or other type of programs out there. We're in Hawaii. A popular down payment source is gift funds from family, aunties, uncles, mom, dad, grandma, grandpas. You tell someone you're buying a house, and all of a sudden you have help from people you never thought were going to help you. I always tell clients that it doesn't hurt to ask. The worst they can say is no. And you'd be surprised how many people were able to buy houses with help from family members gifting down payment money.
Yeah, so going back to the VA thing, you gotta be a
Yes.
veteran. Yeah, you gotta
Ye-
lay your life on the line. So if you
Correct.
haven't done that, cannot qualify for that. Or you haven't married someone who's done that.
Correct. Yeah, the VA, you have to be a VA eligible borrower, and there's a online system that we can check to see if you are or you are not. Most people know if they are or they aren't.
Yeah, a lot of nuances there. I would just contact Regan on the
Yeah,
side for if you
correct.
qualify for that. But for most people, it's a FHA and your traditional Fannie Mae Freddie Mac.
Correct.
What are the kind of the differences between the two?
FHA is a government. Well, they're all tech quote unquote government sponsored loan, but FHA is a government direct loan that um, allows for 3.5% down payment. Now, FHA has their own mortgage insurance premium that they charge, which is upfront, and also a monthly amount that is charged as well. FHA, the rates tend to be a little bit better sometimes, but the qualifying is also a little bit different. FHA is good if you're buying a single family home that's not attached to anything else, because their condo guidelines and their condo list of approved condos is very, 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 very small. And the condo guidelines to get it approved is very, 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 very stringent. So it works for single family homes, or even homes that are not attached. Like, so you have some places that are single family homes that are under condominium regime. As long as you're not attached to any other homes, then you're fine with FHA. And FHA, traditionally, we see that for um, lower scored borrowers, credit scored borrowers, but I've used it for higher score borrowers as well. It just depends on the situation. Now, Fannie Mae and Freddie Mac, they're government sponsored agencies, and a majority of our loans are Fannie Mae and Freddie Mac loans. Those are your conventional type of loans, and the minimum down payment on those are 3% down. If you're a first time home buyer, you can go at 3% down. If you're not, you still could go at 3% down, but it's going to be income restricted, and the uh, income restrictions change every year. So it's about about $77,000 this year, no matter what your family size is. So, those are your traditional conventional mortgages.
And then the
There's
PMI,
yeah.
maybe explain what that is for
Mhm.
folks.
So PMI is private mortgage insurance. So anytime you put less than 20% down on a home purchase, you're required to get PMI, which is the private mortgage insurance. Now, private mortgage insurance is an insurance that protects the lender against default. It's paid by the borrower, but it protects the lender against default.
Yeah,
So
because when you're putting down 3%, it's kind of risky for the lender. So they want
correct.
this insurance, which they're gonna charge you for that.
Correct. And there's different insurance companies out there. And we, our company, we are a national company, so we get a pretty good rate from these companies as well. We shop for the best rate on every transaction as well. So, there's other ways to avoid the PMI. It's not tax deductible as far as I know, but it's not a bad thing because it doesn't stay on forever. And there's different ways that we can work the PMI to kind of minimize your cash flow as well. So and there's ways to avoid it if you're going to do a second mortgage, but it's a little bit detailed. So
So the PMI applies when you're going in with less than what percentage down payment?
20% down.
Okay, and if you are putting down 3%, or 15%, is the PMI the same? Is it kind of
It's a different percentage
all or
depending.
nothing then? Or,
Yeah, no, it's not all. It's a different percentage. So if you're
okay.
if you're putting down 3% down, your PMI coverage is going to be higher than if you're putting down 15%. So, and other factors are going to be your credit score if there's more than one borrower on there as well on your transaction. So it's different factors that will go into what the PMI coverage will be.
Yeah, and we're talking a little bit different stuff normally from our normal channel of investment properties, which are non-owner occupied properties. Most times with that, in fact, they don't allow you to go any less than 20% down payment. But you guys can find more information on that at arialoha.com or simplepassivecashflow.com/turnkey if you're looking to buy out-of-state turnkey rentals there. But today we're kind of talking more about residential home loans. any other questions that people normally ask you, or pitfalls you'll see before we go on to these top mistakes? People get.
Questions that I get a lot is, how long is my pre-approval good for? Your credit report is the main one. That's the one that expires in 120 days from the time that we pull it. Documents, we can always update that, but the shelf life is about 120 days. Now, if we get a pre-approval and we pre-approve you, you're good for 120 days. I'm not going to update you. I'm not going to have you update your file every 120 days. It's when you find something, then we'll update it, because I'm going to assume that everything is about the same as when we last looked at everything, because it just, I understand it's very invasive, and to have you update me every 30 days with pay stubs and bank statements, I understand it's very invasive. And that's another question that I get is lots of, why do you need all of my personal documentation? And I think we covered this earlier, but yeah, it's it's not a small amount of money that's being lent out. So we got to make sure that it's going to be repaid. And it's not a trust issue either. It's like it's not a handshake agreement that we're doing.
Yeah, and just so people know going in, what is some of the big qualification hurdles, like credit score and debt to income ratios that you're kind of looking for?
So I like to look at a loan qualification as having three pillars: your credit, your income, and your assets. The credit score, we can help with that. We have tools to help get your credit score up, fix your credit even if we need to. Your assets, there's ways around that.
What is the credit score there that you're looking for? What is the prime rate? What's the
credit score? Anything above 740 or better is going to get you the best possible rate and terms. 700 would be probably the minimum that you would need if you're going with a minimal down payment as far as conventional loans for. But we can go probably as low as 620 would be the lowest credit score that we're looking at. And we look at, just besides the score, you need to have established credit as well. So, we've had situations where a younger borrower had maybe one credit line on his own, but was an authorized user on other parents' accounts, but scores were 750, 760, 770 kind of range. But because there's no representative score of the borrower themselves, because it's all authorized users, meaning that he's not really responsible for that, the credit score is kind of meaningless. So we look at the overall general picture of the credit as well.
Yeah, and then sometimes people will go co-sign, right? You need parents to co-sign.
Yep. Co-signing is also an option. But, the credit, sometimes people think that there's nothing they can do about their credit, but there definitely is. I mean, we have credit tools that will help them get their score up if we need to. We can send them to companies that will advise them how to fix their credit if it needs to be fixed.
Yeah, I mean, actually, I've been playing around with trade lines where I actually rent my credit card authorized user slots out to people, and then this company pays me. But you can be the person who jumps on as authorized user on account, and not claiming that this works. I just get paid for other people doing it, so I don't really care. But people will pay $1,000 to get on a 10-year-old card with 20 grand of credit, and that supposedly jumps their credit score 50 to 100 points. That might be just what you need to get you up to the prime rate. I know that's what a lot of sophisticated business owners do. They pump their score 50, 100 points, and they go apply for business loans. So it's a lot of ideas there. So what about debt to income, and then how much your W-2 stubs need to be showing?
So debt to income, if you look at the written guidelines, it says that there's a general rule of ability to repay. The written guideline says it shouldn't be more than 43% debt to income ratio. Now, what that means is that you calculate all your monthly obligations, and we use minimal payments on that. So that includes whatever you have as far as car loans, student loans, credit card minimum payments, child support, alimony, any kind of consumer debt that you have or obligations, as well as the new payment for your new home. Divide that by your gross income, average income, and that's your debt to income ratio. Written guidelines said it shouldn't be more than 43%. However, programs will allow you to go up to 70% in some cases for VA. I've seen it take as high as that, as long as your residual income, meaning your residual income after taxes and your expenses, meets a certain level for your family size. So written is 43. I've seen it take as high as 70 in some cases.
Can you walk us through like a quick calculation just so people can roughly calculate their own DTI?
Sure. Let's say you have just for ease of numbers, let's say your income is $5,000 a month, and you have maybe $100 in consumer debt per month. Maybe it's a couple of credit cards, and your new payment on your new home is going to be about $2,400 a month, including maintenance fee and everything in there. So you have a total monthly new obligation of $2,500 a month. We take that divided by 5,000. That's 50%. That would be your debt to income ratio.
Yeah, so they're looking at what it will be after this purchase.
Correct. It's going to be inclusive of all your debts that you're still going to have to pay, as well as your new mortgage payment, your new housing payment.
So if you got a Nissan truck that is a $600 car payment, that puts you in the red, right? That you probably won't qualify in that.
Correct. You'd have to bring in a co-signer or find a way to pay that truck off or
slide that obligation over to somebody else.
I've seen that happen before as well.
All right, so let's dig into some of these top mistakes, because sometimes you talk to your Regan on the phone and it's like it's all good, but then you might say something or do something silly. So let's go through some of these. Don't make the same mistakes, so you don't get that. Sorry, I cannot do anything. So first one here: borrower quitting job after starting the loan process.
Oh man, yeah, that's tough because we need to make sure that you're still employed, and we do checks all the way up until 10 days before we close. So that means we call the employer verbally, say, hey, so-and-so still employed. Yes.
Yeah, so wait till you quit your job or wait till the deal closes till you fire your boss.
Yeah, and I've had an unusual situation one time where the company that the person I was working for had closed down, but they didn't let the employees know yet.
Yeah, so I know a lot of clients who they're quitting their day jobs because they invest in all this real estate and investment properties, but they're always mindful of this and they buy their $2 million house before they fire the boss.
Yeah, exactly.
So borrower opening up new debt after starting the loan process.
This is, it's common sense to us in the industry, but yeah, don't go opening up take out a car loan or co-signing for somebody's car loan, or even opening up a credit card or maxing out your credit card while you're in the process of doing a loan, because that's all going to be found out as well. So we want to try and maintain the status quo. You still got to use credit cards to live your daily life. That's fine. I understand that. But wait on buying that new car. Wait on co-signing for someone that needs that new car. Wait on that big expenses as well. Don't buy furniture until you close. I mean, that's a big one that I see a lot where people will, this big sale, I want to get the furniture. I said, don't put it on any credit right now. Just have someone else hold it for you or something.
Yeah, and I'll say it because I'm not a lending broker and I'm just an investor myself, but have these conversations on the phone with your lending broker. I wouldn't put it in an email, because once you do that, your hands are tied. When I was buying a bunch of property, I did that, and my lender was like, oh crap, you're screwed. Like I got this paper trail now. I mean, my hands are tied, so if you're doing something along these lines, talk about it.
Before you do it would be better.
Right. Your lending broker is your friend. It's the underwriters in the other room are not your friends. And sometimes they're not aligned with your lending broker who, wants you to close the deal, and that's how they ultimately get paid too. But, you got to kind of work with your friends here.
Yeah. I mean, it's always best to, I look at as loan officers as consultants. And you want to run by, if you're in process to buy a property, you want to run everything kind of by them, like major kind of expenses that you're going to be incurring or want to incur. that definitely is something you want to run by your mortgage loan officer.
Yeah, this next one is kind of self-explanatory, but the borrower signing multiple contracts without consulting the loan officer.
Oh man, that's that's one we see not too often, but I do see that, and it's like, anytime you're in contract to buy a property and then you go out and you're going to buy another property, um, all of that's going to count towards your qualifying. So we have to be able to qualify you carrying both properties, even though one is going to close after the other. It's known, so we're going to have to, use it to qualify.
This next one is borrower plans to leave the country on vacation during the closing. Any workarounds around that, or like power of attorney, or?
Yeah, there are, as long as we know up front. So if you know that you're going to be out of the country or going on vacation and you're in the middle of a loan process, let the loan officer know up front so we can prepare for it. Power of attorney is an option. We have mobile notaries available some places as well. Now, if it's a foreign country, you're going to have to go to the consulate to get an appointment for a notary, and that could take up to about a couple of months to get something scheduled. But power of attorney is definitely the easiest option, as long as you know about it up front. We don't want to be scrambling on the day that you're leaving to get this power of attorney signed and notarized, because we still have to get it approved by everyone as well. But there are workarounds for that. And even if it's out of state, we do have e-closings now. Now, there's still documents you've got to sign by hand, because the good old state of Hawaii doesn't allow full e-signings, but we do have situations where we can do e-signings where they just sign as a DocuSign and sign like a few documents that need to be recorded at the Bureau of Conveyance by hand. So there's workarounds for it.
Yeah, communicate. Simple.
Correct. Yes.
Next time, borrower does not get pre-approved prior to putting in an offer or signing a contract.
Those are always fun, because no matter how well you think you are qualified, we look at things as a mortgage company a little differently than how you look at things as a buyer. We only can go off what we see on paper, meaning what's claimed on taxes and everything. Like, I'm not saying that these people aren't making money. I'm just saying that I gotta see what's on paper. But yeah, those are the fun ones, because then you get stuck trying to figure out how to qualify somebody for something that they should have been doing ahead of time. So again, preparation is the key. Like, if you know you're going to be looking for something, get qualified so you know exactly what to look for.
Yeah. So the process here is talk to your lending officer first. Get that pre-approval letter. Mm-hmm. I don't know how you send it out to your guys, but PDF or Word document?
PDF. Yeah, as soon as you qualify, you let me know what you want to make an offer on and what price, so that I put that exact amount in there. I don't want to give you, like, if you're qualified for $900,000, but you're only going to put in an offer for $850,000. I don't want to put on the letter that you're qualified for $900,000. I want you to have some kind of leverage with the seller in case they come back and say, oh, you gave me this letter for $900,000. Why can't you go up to $900,000?
Yeah, something I would do in the past, because I bought so many properties from my lending broker, but I would get it in Word document, and mm-hmm. I would just get a verbal, like, hey man, don't go above this amount. Mm-hmm. And then I would doctor up the document to show exactly what my offer was. So it looked mm-hmm. like that was the highest. I don't know if that matters. It's a little gamesmanship, but just don't put a higher amount than what your lending broker says.
Correct.
And nobody's happy with you.
Yeah. And we get blamed. Even if, like in that last situation, if someone comes to us after a contract without getting pre-approved first, we get blamed for the loan part of it falling through. Like, what do you want me to do?
Yeah. And this is the time where I'm saying consult your professionals. I'm just telling you what I did, not saying it's the right thing to do.
Right.
Next one here, borrower buying multiple properties at once with different lenders and does not disclose. Well, can they buy multiple properties? Let's ask that question first.
Yeah. It's possible to buy multiple properties at once. Again, we just got to take into consideration all the pieces of it qualifying. If you're going through different lenders, it makes it a little bit more difficult, because now we got to coordinate with two different lenders, and we got to see what the payments are going to be and what the drain on the assets is going to be and all of that good stuff as well. So it is possible to do it with the same lender and across different lenders as well, but you got to disclose it, because if not, eventually we're going to find out.
Yeah, I bought 9 properties in like a 6-month period, and it was nice because I only had to do the DNA samples and
Yes.
once.
Yes.
But I was only, I was only using one lender to do all that. Granted, it's only $100,000 rental properties. It wasn't like $1 million Hawaii house, but yeah, multiple properties you can do that. But just don't do this like rate shopping thing where you're like getting 3 with this guy and 2. That's when you're gonna run into problems.
Oh yeah, I mean, do your rate shopping ahead of time, and truth be told, rate is not the most important thing in a mortgage loan. Is getting it closed, and getting it closed according to the contract terms is the important thing. Because people don't understand that the contract to buy a property is an actual contract. If you don't perform on that contract, meaning everybody doesn't perform on that contract, the seller can keep your deposits.
Right. And that's, I'll say it, like, I mean, if you're going to like a big bank, they just have like the 20-year-old kid working these loans, and who knows what they're telling the bad guys in the back curtain, the underwriters, right? That's what we're talking about. Your deal not funding.
Yeah.
Because you're working with a newbie who's never done this stuff and just saying yes, 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 yes until the final stages, and then now you get screwed. And you possibly lose your earnest money too.
Exactly. And it's not just the big banks as well. I've seen it with other mortgage lenders too. So you just want to make sure that you're working with somebody reputable and that knows what they're doing, because sometimes, I hate to say it, but you get what you pay for. And if you get cheapest rate out there, you're going to probably get the cheapest service out there as well, kind of situation. But yeah, I would just whoever you trust. I don't know, man.
Some people like to do that whole like with $150 listing fee out here in Hawaii. I don't know what that's all about.
Oh, the flat fee guys. Yeah, exactly. Like I said, you get what you pay for.
You guys go hang out by yourselves.
Exactly.
But, another one here: borrow does not disclose free and clear properties.
That becomes a problem because even though it's free and clear, there's still expenses on the property, property taxes, possibly home insurance, probably HOA dues. So again, that all factors into qualifying. Even though you may say, "Oh no, I don't pay any of that. My parents live there, or I have relatives living there. They pay for all of that." If it's not on paper, I still have to hit you for whatever the expenses is for that property.
Right. That's better be making income, right? If it gets a legit. Not under the table rental property, you can show the income for that.
Correct.
To offset your debt to income ratio.
Yes.
And then just general borrow, not being upfront about anything that relates to the loan. You got anything that comes to mind with that someone didn't disclose?
Yeah, actually, I had someone when I first started. We ask on the loan application, are you obligated to pay child support? And this person put no. Turns out
what they think, what the government thinks.
Right. So it turns out that through the loan process, we found out, hey, he has to pay child support. So I asked him about it, and he said, "Oh, yeah, I have to pay it, but I don't pay it." I said, "Well, that's a big difference because being obligated, but not being upfront about everything." Like I said, because this loan process is so detailed and intrusive, we will find out about it. Unfortunately, there's not much that you can hide in this day and age either. So the more upfront we know about it, the more we know how to address it and maybe work our way around it.
Yeah, and this last one, not seasoning funds, is a little tricky.
Yes.
Maybe we can talk about this a little bit.
Yeah. So season funds, when we talk about season funds, it means that's money in the bank. So normally you want to have the money in there for at least 2 months. So we have 2 months of statements that don't show the money going in there. And if we look at like the average balance. So if we see in November statement, oh, 100 grand went in there and we don't know where that's from and you can't source it, or you know it's from, but we just can't source it or paper trail it, then we'd have to wait until we get January statement, and hopefully nothing went in there in December and January to throw us off again. Because the January and the December statement aren't going to show a large deposit.
Yeah. So for rental properties, they're usually going to want to see you have like 3 to 6 months of cash reserves to pay the debt service on it. That always changes. But what is it for owner occupied residential? The cash reserves needed. Do you even need any, or?
Sometimes no, we don't, and we run it through an automated underwriting system that will tell us what we need, how much we need, etc.
So I'm just thinking from the eyes of the lender or the person lending the money. As long as your debt to income, as long as your future earnings on the month-to-month basis cover you, they're cool, I think.
Correct. Yeah, as long as you have that. I mean, investment properties, yes, you do. Non-owner-occupied properties, you do need reserves anywhere from 2 to 6 months on the subject property that you're buying, and maybe 6 months on the other properties that you own as well. And the reserves covers whatever the monthly expenses are. So if there's mortgages, payments, HOA dues, etc. But owner-occupied, you could probably get away with maybe 2 months, I would say. For a conventional type of loan, or sometimes you might not even need any reserves.
Yeah, but the big thing is like, where is this down payment coming from? And it can be gifted.
Yes.
But the money needs to be in your bank account. What, 2 months or no?
The gift, for the gift part of it, the easiest way to handle the gift is have the gifter, the donor, write a cashier's check directly to escrow when we're ready to close. So that way it's simple. We just have to get the gift letter signed and then evidence the transfer, which is the money, copy of the cashier's check going to escrow.
Okay. So do they need to disclose if it's a gift prior to closing?
Yes.
Okay.
And it's a gift for the loan purpose.
Okay.
We don't report that to the IRS or anything like that. It's a gift for the loan purpose.
Yeah. So if it's not a gift and this person is going to come up with their down payment on their own, you're going to kind of monitor their bank statements for large infusions or large withdrawals.
Not necessarily withdrawals, but the withdrawals do affect the qualifying, because if you need 30,000 to close and you only have 40,000 in your bank account, but you take out 20,000, then we're short cash to close. But for the most part, we're just making sure that we have enough in there to close, and that we paper trail or source any large deposits over 50% of the qualifying income we're using.
Yeah. So if you're making $5,000 a month and a check comes in for 3,000, you're gonna source it. You're gonna ask for an explanation, which could be as easy as a simple email.
We just have to say, okay, where did this check come from? Oh, it was a refund from such and such company. So, or it could be, I got into a car accident. This is the insurance paying me back. So
what would be some? People do all kinds of random stuff, right? What would be some like things you'd be like, oh no, that doesn't count, man? Like, other than illegal sales of drugs or that type of paraphernalia, what would be a non-qualifying infusion into the bank account that you guys would say, no, we can't count that?
Well, being in Hawaii, a lot of people have mattress money. So it's cash that they have, and I know it's theirs, but I can't prove cash is theirs. So, and people do that too. I mean, I did that for a while. I just had all my, when I was working as a bartender, I'd have all my cash tips in my house, and I wouldn't deposit them. But I see a lot of cash going in. It's mattress money kind of thing. And then there's some old school people that don't trust banks, so their money is held as cash. So.
Yeah, I mean, most of my Alabama rentals, they would go to Walmart and do like
cashiers, right?
I get it.
Yeah.
Uh-huh.
Yeah. So I've seen, the cash infusions go in. I've seen where people will tell me like, oh yeah, this is, so and so is paying me back for something. I said, I can't use that. I need to show that you gave them the money first, and then the money's coming back to you. If you're selling something, an asset, I gotta prove that you own the asset first, and then I got a receipt that somebody bought it from you.
Yeah, I sold my CrossFit gym equipment so I could buy this house. They pay me $4,000. They're gonna have to show a paper trail for that.
Correct. Yes.
Yeah. Okay. Well, cool. So we covered a lot of stuff today. If you guys are interested in investment property stuff, go to simplepassivecashflow.com/turnkey. But if not, check out our buddy Dean and I do the Real Estate Brothers every month. We broadcast that live. But anything else, Regan, you want to get your contact information out there, or anything else you think the folks need to know before this process?
Nah, like I said, the easiest thing is contact whoever your loan officer is, your lender is, and get everything done up front. Get the pre-approval done up front before you start looking. I mean, you need to, buying a house, it shouldn't be as stressful as some people make it out to be. If you're prepared, get pre-approved, do you know what to look for? My contact information, my cell phone is 808-780-3136. Email, probably the easiest way to reach me is Regan, REGAN .ONIKAM as in Mary A at Fairway FAIRWAY M as in Mary C.com. So I work for Fairway Mortgage. That's fairwaymc.com.
Holy jeez, that's a mouthful.
Yeah, it is.
Hey, we'll put it up on raloha.com in the video section, so you guys can check this out later. But thanks, Regan, for coming on.
Appreciate it. Thanks, Lee.
Hey, take it easy, everybody. Bye.
Free real estate investing group. Check out reialoha.com.
We're just two local guys with so much to say. So listen to the Real Estate Brothers today.